worsening crop condition in the US. We are going to talk about that and, as always, about the economics that might impact your farm or you as a trader. Right here on Connected Farmer, your channel to keep you up to date with the latest trends in agriculture and livestock. If you are new here, please make sure you subscribe. So, Mike, how are you today? We have a map of conditions in the United States, and what exactly is going on in Illinois, Indiana, and Ohio?
Well, the big thing to look at in terms of the map and then also the following graphic of the table, Luis, is I took both the topsoil moisture conditions at the current time period, the subsoil moisture conditions at the current time period, and compared those to in the key states where the USDA is giving us record yields. I didn't include Michigan, but it's interesting. The five states that are highlighted are Michigan, Illinois, Indiana, Ohio, and Kentucky, all of them looking at record corn yields this year, which I thought was very strange given the crop conditions. And then when I started looking at the topsoil and subsoil moisture levels for Illinois, Indiana, Ohio, and Kentucky, and then I threw in Iowa just because Iowa is really the main state that drives the national yield here in this country. It became very clear to me that the topsoil subsoil moisture conditions were running very, very similarly in Illinois, Indiana, and Ohio to just a year or two ago. And so I went back and looked at the 2019 yield levels in those three states and put those up on the map in red against what USDA is calling for. And what this shows me, along with some other analysis, and keep in mind, my yield model that I use is very analytical and it has certain characteristics or features that I increase in terms of weighting or priority in figuring my national yield. So it's not every year that this kind of analysis you and I are looking at right now will be a top level factor. It can be, or it may not be. This year it happens to be a top level factor. And so when I looked at this as a top level factor, I was stunned to think about what this could do to the national yield if USDA is just a few bushels off in these three major states. And Iowa's not there to help. That was the kind of the key point about the Iowa crop conditions and the subsoil, topsoil moisture levels compared to the last 3 or 4 years. So this takes me back to not wanting to change my national yield in the U.S. corn expectations above 175 bushels. And this is actually matching up very, very nicely with extremely early going in harvest here in the United States, but very disappointing harvest numbers for the most part in central, east central, west central, and central Illinois right now. Not a lot of being done in Indiana and Ohio yet. But if that trend continues, the USDA may be pretty far off on their yield expectations for these three states. And these three states really are going to have to carry the national yield this year. And that's in part why this is such a higher priority issue. And this factor is so highly rated in my yield model this year. So if I have a 175 yield and I take 4 to 5 million tons off of the Brazilian crop, all of a sudden we're talking about 400 to 475, maybe 500 million bushels of lost production in the world for corn. And with Brazil and the United States being the two main ones for the export market here, you're talking about a world stocks to use ratios that's right back down to around 24%. So that really opens the upside potential up in the corn market, unless we have some kind of policy change on ethanol or something like that.
Yes, and what do you think will be the impact on wheat?
Well, this is where wheat is going to need to be the impact on the corn. I think that's where the USDA report matches up with my analysis before the report very, very well, that wheat needs to be the leader. It does not have harvest pressure, but it's more sensitive to the currency markets. And so if we have a weaker dollar and a lack of harvest pressure, and the USDA report shows tighter supplies, and stocks to use ratios that are at their 3, 4, 5 year levels. And in some cases, depending on what number you look at, we're down to the lowest level since 2012, 2013 in wheat. You have wheat as the leader to the upside, in my opinion, as far as a must have. And so the more the wheat plays along, it's going to be, I think, because the more the dollar plays along. And the more the dollar plays along, the more the inflation guys will play along. And that opens the upside up even more in the corn and to a lesser degree the beans. But that's kind of the stair step mindset that I have right now, that as we enter harvest, unless the yields continue to be very disappointing for the corn, the wheat needs to find the low first, especially now that the September contracts are expired after today's close. If wheat finds a low, then we have more potential for the corn to find a low. I think by the time we get to the stocks and grain stocks, quarterly grain stocks numbers here at the end of this month. And by the way, very nicely done on your Brazilian corn expectations. You told me last time we spoke that the USDA and CONAB would not, or CONAB probably would not lower as much as they probably should. And that's exactly what USDA and CONAB did by only taking down the corn production a little bit, and that being offset by raising the corn expectations for Argentina. So that's still a big issue in my mind as far as lower Brazilian corn crop.
Yes, and what about your opinion on the soybean yields in the US and its market effects?
It's too early to really say much right now. I talked to a Kentucky client today who had gotten into a field last Friday and had only done about 65 bushels to the acre. He was in a field today, though, and it hit 90 bushels to the acre, and his average is going to be well over 80. It's just way too early right now, but Luis, the way these topsoil and subsoil moisture condition levels are, the USDA is not as gutsy as poking in record yields in soybeans as they are in the corn. So that's one thing to watch out for. But if it's dry, it's going to be dry on the beans as well. So I don't believe that we're above a 50 bushel yield in the soybeans, but I'm less concerned about the soybeans rallying, A, because they already have, and they've kind of done it without the supply demand fundamentals supporting it. I mean, USDA's 99 million metric tons ending stocks for the world. That's a massive number in soybeans. And so between that and the uncertainty in China and also the uncertainty on some of the other demand fronts, it makes me feel like the beans have an adequate premium in them given the harvest right now. And what I mean by that is back in 2019, 2020, in the 2019 crop, we had a 175 million bushel carryover yield here, carryover here in the United States. And that equated to about a $10.90 average price. Well, here we are stuck up around, $12.50, $13 for cash prices at this point. So we're well above the average cash price from a couple years ago when we had about the same type of carryover levels.
Now I want to hear your assessment on inflation. The United States has published new data on inflation, and it seems to have slowed down recently. So, what do you think that will influence the future Fed decision?
Yeah, that's a really big point right now because we saw before the USDA report that the dollar hitting fresh almost 2 month highs before the report came out was mostly on the idea that the Fed was going to taper. And if they taper and they cut back on their monetary policy easing, then we're going to see the inflationary bias be reduced. Now, with the CPI number coming in less than expected, the consumer price index coming in at 5.3% year over year for the month of August, lower than the trade expectations, that actually has broken the dollar back because the Fed taper maybe will be put on hold. So it's a real weird market we're dealing with right now in the currencies, Luis. We're trading more expectations about the Fed than we are the monetary fundamentals. We're trying to game out or predetermine in the currency markets what the Fed's going to do. And that's going to put us in a really tricky situation here in the next couple, 3 months, I feel. My expectation is that between the jobs numbers and and the inflation number that we just saw on the consumer prices, that the Federal Reserve will not feel like they have to push very hard on raising rates, especially if we don't get the fiscal $3.5 trillion bill passed in the Congress, because that $3.5 trillion bill is going to be the biggest hit to our inflation that we've probably ever seen in the last 60 years in the United States. So if that bill passes, because that's going to be 3.5 plus another 1.5 roughly of the infrastructure. So you're looking at least $5 trillion hitting this market if those bills pass. That's going to be directly influencing inflation here in the United States. That I think will make the Fed react and have to taper back. So my expectation is the Fed will have a hands-off policy in the next 3 months. They'll do a wait and see attitude in the fourth quarter. If that's the case, the fundamentals lean towards the dollar weakening, not strengthening, and that'd be really nice, especially if we could get into harvest more properly here in the United States and not see the yields that USDA is expecting.
Yes, we can jump into the outside factors right now. And Brazil has imported a lot more, over 100% more than last year of corn during the month of August, and September so far has been well over the average. So, do you think that the outside demand for corn will continue to increase?
Well, I'm going to ask you a question first because I did some digging after you had told me about this. And I saw that the USDA Ag Attaché is looking at another 3% increase in Brazilian poultry production. And it's going to be nearly 15 million metric tons. And the viewer may not understand that Brazil is the number one chicken meat exporter in the world. And so I really wonder, between the beef and the pork and the poultry supply or production needs that Brazil needs domestically, how the Brazilian farmer is going to be able to keep up with those kind of exports in the next 6 to 9 months, especially given that we're looking pretty dry again. And it sounds like, from what you were telling me, the southern Brazilian farmers are really nervous about expanding their acres again. So I'm really nervous that the Brazilians are not going to export hardly any corn after we get into the fourth quarter. And then all of a sudden that opens up the door for the United States export market, as long as the currency relationship's friendly. Does that make sense to you?
Yes, there is a growing concern about the livestock production in the southern parts of Brazil, because this region used to plant a lot more corn and a lot more wheat. But as soybeans got more profitable over the years, there was a shift for soybeans, and yet the corn and the wheat came from more competitive places in the country and from around the world. So there isn't enough supply right now from this specific region, and the only solution is to source from other places.
And how does that work with the Paraná River? Has that gotten any better with some of the rainfall, or are you still lacking rainfall and it's going to get worse as you get into the summertime?
No, there was significant rainfall in Argentina in the last 2 weeks, so that improved navigation there.
Okay, great. Yeah, and so I think we're on the same page when it comes to the corn export potential for the United States still being very, very strong. And the soybean export potential, in my opinion, for the United States is just going to be about whether we can get it out the door because of the hurricanes. I heard today, in other words, that the Brazilians were able to take in some spot purchases from China because China couldn't source anything from us here in the United States, and with their crush margins improving dramatically, they wanted to get some boats on the water to be able to take advantage of that. So infrastructure is going to be a big deal here with these hurricanes we've had, and getting back up and running to 100% capacity at the terminals. But I think it's really going to be about the currencies. I think the soybeans are going to be really in 2022 heavily influenced by the real and the US dollar mix. And I think the funds will tap into that very, very substantially in terms of the managed money fund investment in that currency exchange rate trade.
And do you see the African swine fever as a growing factor for outside demand?
Yeah, I do. And I think it's getting more and more. I know we're putting in some pretty strong policies to try and keep it out of our country. But with our southern border being more porous than it has been in the last 10 or 15 years, and the numbers that I'm looking at monthly of crossings at this point, it can be tracked in by humans. There's just no way around it. And so I'm very nervous about that disease at this point, especially as we get into the wintertime months. And that tends to be what makes markets really go sharply higher is when we have a major disease outbreak someplace. And so this is where, as a hedger, when I know that we're going to have tightening supplies of beef, especially in 2022, and not as much increase in pork in 2022 here domestically in production numbers, rallies that I'm going to hedge, Luis, are probably going to be in puts as opposed to short futures, because I don't want to do a year's worth of damage over an outbreak of disease when the producer won't have the hogs to sell or the cattle to sell and the prices are sky high. So I don't want to lose on both ends, in other words, and that can happen. And I think we have to be ready for that to happen more often with disease pressure.
Very nice conversation with Mike Zuzolo. Thank you, Mike.
Thanks again, Luis, for all your work too down in South America.